Doodle-doo, and we're back with another episode by Dot Daily about the Polkadot ecosystem. Today we'll be talking about Polkadex, so let's get into it. Lately, the world has been changing at the speed of light. As we're making more and more technological advances in every field, the way people conduct financial transactions evolved as well. A strong need for a financial system that would preserve capital and generate wealth for people all over the world lead to the birth of a decentralized financial system. DeFi marks the new era of transferring financial system from the traditional fiat system to the decentralized one. In the past few years, especially during the COVID-19 pandemic, the blockchain market flourished with many decentralized exchanges and protocols. The cryptocurrency trading community has also grown quite significantly, as major companies now accept cryptocurrency as payment. El Salvador even went as far as to adopt Bitcoin as an official currency alongside the US dollar. Still, DeFi needs to attract a lot more users to gain mass adoption, as it still loses to the centralized solutions. The modern user has to settle for a compromise instead of a perfect product, no matter whether the choice is centralized or decentralized trading platforms. But Polkadex is a new fully decentralized peer-to-peer order book-based crypto exchange that has combined the benefits of both centralized and decentralized exchanges, so crypto enthusiasts get the best of both worlds. But before we explain what Polkadex is, it is preliminary to gain a better understanding of cryptocurrencies, so let's get into the details. Cryptocurrency markets can be broadly divided into two categories: centralized, exchanges that always feature the order book, and decentralized, can be with or without the order book. Each of these markets come with their own merits and demerits. Although the decentralized markets are superior to the centralized ones, they also have their own shortcomings. We're going to explain each market in detail, their merits and demerits, and how Polkadex tries to solve all the problems related to crypto markets by combining the benefits of centralized and decentralized exchanges. So without any further ado, let's begin the video. But before we get started, make sure to smash the subscribe button and hit the bell icon to never miss any interesting video from us. Having said that, let's get into the video. Centralized markets. These are the markets where buyers and sellers can offer prices at which they are happy to buy or sell assets in the exchange, forming the list of future orders. They're also called order book markets. The trade is executed if there is a small match between one user's buy order price and another user's sell order price. This matched price then becomes the asset's new market price. Order book markets enjoy a wide range of benefits, but at the same time, they have some disadvantages on some important aspects. The main advantages of centralized exchanges are user experience and low latency. Centralized exchanges are usually the most user-friendly, as a big part of their audience is newcomers to the crypto industry. Hence, the design is more intuitive and the platforms are easy to navigate even for traders buying crypto for the first time. Moreover, users can convert their fiat into crypto directly on the exchange. Latency means the time that it takes to place or edit an order in the order book. Centralized exchanges are fast and can process a transaction in only about 20 milliseconds. The main disadvantages or question marks in the trading experience on centralized exchanges are security and KYC. Being a digital currency crypto must be resistant to hackers and malicious people. As a trader or simply a cryptocurrency holder, you want to be sure that your funds are always safe and will not just vanish in thin air for any reason. There are two risks here: the exchange getting hacked because its security was not top-notch, and founders of exchange running away with your funds. While the latter can be eliminated by choosing a trusted exchange, the security issue of centralized exchanges does not have any real remedy yet. Hence, to keep your crypto on a centralized exchange, you have to fully trust the team behind the exchange and accept that your funds are always at risk. It is a very big ask from the user, and many traders resort to moving their funds back and forth between the exchange and cryptocurrency wallets every time they want to trade. Such activity comes at a cost, as traders have to pay the fees for each transfer. Another limitation of centralized exchanges is a KYC, Know Your Client procedure. Each market participant has to go through a thorough process of submitting personal information, including IDs, to assure data security. While the traders might be comfortable sharing their data for KYC for a good cause, they don't have full information about its further use. As a user, you definitely don't want your personal information to be leaked on the internet or your data to be used for various malicious purposes without your permission. Now that you fully understand what centralized markets are, let us jump to the decentralized markets, which are going to be main point of our focus for the rest of the video. Decentralized markets. Decentralized exchanges emerged not so long ago to solve the limitations of centralized competitors. These markets depend on passive market making and are controlled purely by supply and demand, or AMM model, automated market maker. Some of the well-known examples of such exchanges are Uniswap, Balancer, and SushiSwap. AMMs allow permissionless and automatic ways of trading digital assets and use liquidity pools instead of a traditional market with buyers and sellers. Liquidity providers, or LPs, are users who supply their crypto tokens and for a liquidity pool. In this case, prices of tokens are determined by a constant mathematical formula. Decentralized exchanges are open for trading 24/7 and do not rely on the traditional interaction between buyers and sellers. They're the embodiment of initial crypto ideas. No single entity is in control of the system, and anyone can build new solutions and participate. As a user, you trust the code instead of trusting the company. Users of decentralized exchanges can forget about the risks of hacks and non-transparent KYC processes. Trading on a decentralized exchange, users need only to connect their wallet to execute the swap between cryptocurrencies of their choice. Funds are not kept in the exchange but move directly to and from the wallet, so security is not compromised at any point of the trading process. As the funds always remain with the user, there are fewer risks involved, and the whole system stays very secure. Decentralized markets are a great solution to the disadvantages of centralized exchanges, if not all the negative properties of such markets. However, decentralized exchange users suffer from a wide range of limitations of their own, such as price shocks, slippage, front-running, and arbitrage. We all know these terms are sounding confusing to you right now, but let us explain them and you will have a clear mind. Price slippage happens when the user places a trade that is larger than the liquidity available in the market. Using a simple analogy, if you're trying to buy more apples in a market with limited supply, the price of one apple will increase. On the other hand, if we don't allow the seller to increase the price of the apples, then the seller is losing value by providing apples to the market and has more incentive to just hold on to his apples. Similarly, the AMM increases or decreases the price of an asset to protect the LP in case of mass buy or sell events in the market. This is outlined in the Uniswap model through limits for price slippage tolerance. The higher the slippage that you're ready to tolerate, the easier your swap will go. Arbitrating. We all know cryptocurrencies are traded in hundreds of different exchanges. Sometimes, the price of a coin or token may vary on one exchange to another. That is where the classic Wall Street strategy of arbitrage comes in. Cryptocurrency arbitrage is a strategy in which investors buy a cryptocurrency one more exchange and then quickly sell it on another exchange for a higher price. Capturing the arb means taking advantage of the price difference on two different exchanges. For example, if one exchange is selling Bitcoin for $53,000 and another is selling Bitcoin at $53,400, an arbitrator can purchase Bitcoin in the first exchange, transfer the purchased BTC to the second exchange, and sell it at a higher rate. Since there are over 300 spot market exchanges selling crypto assets like Bitcoin at slightly different prices, there are countless crypto arbitrage opportunities. This explains why traders are increasingly looking for ways to efficiently identify these opportunities and capitalize on split-second price differentials across multiple exchanges. Front-running is an issue related to the blockchain and not the AMM pool directly. Ethereum-like blockchains prioritizes transactions with higher gas fees. As blockchain is transparent, anyone in the network can see other transactions in the queue. Imagine that someone in the network notices that you're buying a lot of asset X. Likely that after your transaction, the price of the asset will increase due to increased demand. Seasoned traders can execute their transactions before yours by setting higher gas fees for the transaction. In this case, your swap price will go up and you will end up purchasing the asset at a higher price than you originally intended. High transaction fees are inevitable for exchanges based on the Ethereum network. Users are often spending over $1,000 to execute a swap transaction, hence DEXs are becoming a less attractive option for smaller traders. All in all, traders who use decentralized platforms don't have any other choice but to agree with the risks. Currently, there are no platforms that can prove they eliminated the mentioned issues in a decentralized environment. What is Polkadex? Polkadex emerged as a cryptocurrency to solve all these problems with the current crypto exchanges. Polkadex is a non-custodial, fully decentralized, peer-to-peer order book-based cryptocurrency exchange for the DeFi ecosystem that combines the benefits of centralized and decentralized exchanges into one. What problems does Polkadex solve? One of the main issues plaguing decentralized markets built on Ethereum is the crazy gas fees. This issue demotivates millions of users from using DeFi protocols. Polkadex's Polka Pool fixes this by offering swaps without any gas fees. Polka Pool not only introduces free swaps, but also eliminates front-running, a phenomenon in which wealthier traders cut in line and therefore get ahead of other traders by opting to pay higher fees. Free swaps and extremely fast transactions on the Polkadex completely eliminate the possibility of front-running. So how does Polkadex manage to solve all these problems? Now you might be thinking how Polkadex manages to solve all the problems related to decentralized networks. Well, it is because it uses a unique architecture combining multiple technologies like blockchain, parachain, TEE, IPFS, and other blockchain technologies. Polkadex order book consists of four fundamental parts: the native blockchain Polkadex network, the Intel-invented, trusted execution environment tech applied to crypto for the first time, the order book engine that maintains the high-performing order book and matches trades on it. IPFS is the exchange's insurance policy. Polkadex token. The token of Polkadex is PDEX. With a limited supply of only 20 million tokens, PDEX supply is designed to fluctuate at times thanks to the automated burning mechanism that will bring it back to the max amount using a network-regulated automatic system of token burns. Currently, only around 15% of the total PDEX is in circulation. The remaining tokens will be distributed and allocated after the mainnet launch. PDEX can be used by the users to pay and get discounts on transaction and trading fees, participate in Polkadex IDOs, participate in on-chain governance of the network, become a validator of the network by staking, nominate validators and collators of the network. That brings us to the end of our video. Thanks for watching, like, comment, subscribe, and until next time, a doodle-doo to ya!